what do you think of this response here of the Fed? Is there anything in it that surprises you, or anything that would change anything that you're doing with your as you manage assets?
Yeah, no, it's interesting. We were certainly keeping an eye on that economic growth projection, especially now that the vaccines are starting to roll out. Would the Fed react to it? And it's interesting that they did raise GDP forecast from 4 to 4.2%. As Steve noted, that's well above potential growth rate at about 1.5 to 1.8%. So for us, that just kind of reiterates the message that next year could be a good year in terms of growth. You have to be careful about this view becoming more and more consensus. Obviously, we've had a nice run already. S&P broadly has been up 8.5%, 9% this quarter alone. And that value rotation that we've really seen over the last few weeks continues to have some legs, we think, in 2021 as well. But certainly the Fed is reiterating some of that positive growth outlook that we expect. And from our perspective, that probably means, probably comes more towards the second half of next year. So other than that, we were looking for the guidance around the bond purchases, as Steve mentioned as well. And I think the market will be at least satisfied with them updating that to some extent, remaining supportive.
So, John, obviously financial assets depend in large part on financial conditions. The economy looks, according to the Fed, I don't know how good their prediction rate is at being accurate, but the one thing we do know is that interest rates are going to be very low for a very long time. That makes money very cheap. That's got to help risk assets.
Yeah, I think that's right. It's really the combination of two things that matters, Tyler. The first is the above-trend growth, which you were asking Steve about. But the second is, even though growth is going to be above trend, the Fed is still going to be very accommodative. And so we already knew that from their guidance on rates. And the new guidance on asset purchases kind of brings that in line. So what the Fed's saying is, even as growth accelerates or exceeds expectations next year, they're going to continue to buy bonds and they're going to continue to keep rates at zero. I think you're right. That is a very supportive backdrop for markets in general. We need the economic growth to come through, and so it's primarily conditional on, the pandemic subsiding and economic normalcy returning. But if that happens, having an accommodative Fed, I think, does provide a very constructive backdrop. And the announcement today on continuing bond purchases throughout that period, I think, is important and goes in that same direction.
Shepard Smith here. Thanks for watching CNBC on YouTube.